Reporting your or even your parents' financials on the FAFSA seems to be a huge area of question, concern, fear, but honestly, it's not that bad. Let's go through some of the common questions we receive, some of the guidance that we've offered to others in the past when it comes to reporting your FAFSA financials. The FAFSA has actually made it pretty easy for a lot of people to report financials. With the implementation of the IRS data retrieval tool, the IRS DRT is another way you'll see that. It makes it easy for those who submitted IRS tax returns to the IRS to have the information automatically imported. That way you don't have to do too much lining up of determining what information to report from your IRS tax return. However, it is understandable if some don't feel comfortable doing that. It's completely your choice if it's an option for you, and for others, it's not an option. You do have to complete the FAFSA financial questions without being able to import information. The FAFSA has done a pretty good job of letting you know where you can find the information that it's asking for. Now, some things you want to look out for. If you're going to use the IRS DRT, then your Schedule 1 information will be automatically imported into your FAFSA. Along with all the other information imported from the IRS DRT, it will all be masked and you will not be able to see it, but the questions will be answered appropriately. In the past, when there's more of a variety of different tax forms, like for example, the 1040, 1040 Easy, the FAFSA could make some assumptions based on the type of return you filed. However, due to different changes in IRS tax law, the forms are more limited these days. And the only way to determine if you qualify for something like an automatic zero EFC is to identify the information you would have reported under Schedule 1. Look out for that question if you filed a Schedule 1 with your tax return, and make sure you answer the questions provided appropriately. It's very specific of what they're looking for and what needs to be reported on the FAFSA and what does not need to be reported on the FAFSA from a Schedule 1. Now, let's go over assets. Assets, by far, is one of the most common questions we get. Which assets do you need to report? Should you move assets? How to handle assets. When it comes to the FAFSA, there are very specific reportable assets that it will ask you for. Make sure to answer the asset questions truthfully. If you're looking for strategies to minimize the impact on assets on your FAFSA, then it's time to talk to a certified financial planner or someone who can give you guidance on the impact of changing or moving any assets in order to qualify for additional financial aid. Remember, the FAFSA form and federal student aid is really looking to identify those who would be considered low income in order to offer them need-based aid. When it comes to the FAFSA, there's a handful of non-reportable assets that people wonder if they'll need to disclose, like the net worth of your family's principal residence, the house that you live in most of the time. That's not required to be reported on the FAFSA. However, if your school requires a CSS profile, you are likely going to report the net worth of your family's home on the CSS profile. The FAFSA will not ask you about your primary residence. It will ask you about other residences or homes that you own that are not considered your primary residence. Small business owners who own small businesses and are controlled by your family, you'll only have to report that small business if you have over 100 full-time employees. If you have under 100 full-time employees, it won't be reported on the FAFSA. Something else that's not reported on the FAFSA, any qualifying retirement plans like a 401k, 403b, pension plans, traditional Roth IRAs, KIOs, and other types of plans could be considered non-reportable assets on the FAFSA. And other non-reportable assets include things like personal belongings. The FAFSA will clearly explain what needs to be reported and what doesn't need to be reported. Now let's go over quickly some reportable assets. Things like cash on hand, including the balance on the day that you're completing the FAFSA of your bank accounts, your savings accounts, or even your checking accounts. Some financial investments would also need to be reported, but once again, we're not talking about qualifying retirement plans. Now, when we get into the super technical parts of this, Assets are assessed differently if they're considered to be assets of the student or assets of the parent. Students' assets tend to have more of an impact on the FAFSA than parent assets. For students, there's a flat rate at which assets are assessed. For parents, there's something known as an asset protection allowance. You might see it as an APA on some websites or during some explanations about how assets are assessed for the FAFSA. And because there's an asset protection allowance for parents, some parents find it more beneficial to have more assets be attributed to them rather than their student. Let's talk about income because it's extremely important to understand the impact of income on the FAFSA. There's certain scenarios, if you're determined to fall below certain thresholds, you could qualify for what's known as an automatic EFC, expected family contribution, which would mean you would not be required to report certain assets on the FAFSA. That's another reason to use an electronic version of the FAFSA, either online or through the mobile app. It will know and only ask you the questions that apply to you based on your answers. If you provide income information, which would then eliminate the need for you to report assets, then you don't have to worry too much about those asset questions. There's an income protection allowance built into the way that EFC is calculated from the FAFSA. Any income above that income protection allowance is considered discretionary income, and that discretionary income will have an impact on the way your EFC is calculated. Obviously, the more income you have will affect your eligibility for financial need. Student income over the income protection allowance is generally assessed at 50%. Parent income assessed over the income protection allowance will not be assessed at a flat rate like the student income. It'll be calculated based on a sliding scale, and every year that sliding scale changes just a little bit. But in years past, that sliding scale still tends to be under the 50% assessment that a student would have. So basically, a student's income will have a larger impact on the expected family contribution calculation than a parent's income would have. Now, is there a maximum income that you can have to apply for the FAFSA? The answer is no. There is no maximum income. Some families don't feel like the FAFSA is worth their time because they already anticipate that they won't be eligible for any sort of need-based aid. The information you provide on the FAFSA, which results in an expected family contribution, is used by the school to determine what types of financial aid they can offer you. Although the federal program may be limiting on the need-based aid, there are some non-need-based aid programs like a direct unsubsidized loan that could be offered, as well as the Direct Plus loan, which could also have an additional application but will require the FAFSA. There are other types of aid that would have different thresholds, like state aid or school aid. So you might want to consider the FAFSA just to be eligible for those programs. Some states may even require you to complete the FAFSA in order to receive any sort of state aid, need or non-need based. When it comes to reporting assets and income, we get questions all the time about how to minimize the impact on my FAFSA form or my child's FAFSA form. In all honesty, when you're answering these questions, make sure you're providing the information asked. If you have any questions or any concerns about what the question means, the FAFSA thankfully has a little information button next to each question online, as well as the paper form, which provides an explanation of each question to let you know exactly what they're asking for. When it comes to moving things around, shifting assets, finding ways to reduce your income, then you're getting into situations that could have other impacts and may not actually provide the result that you're looking for. You want to be truthful and honest, and you want to provide the correct numbers. If you're intentionally providing false information or misleading information on the FAFSA, there could be some serious consequences. It could be, and this isn't limited to this, but a fine up to $20,000 and or 5 years in prison. So we recommend always tell the truth. Remember the intent of the FAFSA form. It's to help the schools determine financial aid packages for the student. Although federal student aid may be limited in the type of need-based aid it offers, the school and your state may have other programs that have different income thresholds. So we always recommend that you complete the FAFSA regardless of your income, and that you always report the information truthfully and accurately. So if you want professional advice about moving your assets or finding ways to reduce the impact of your assets and income on your FAFSA, we recommend that you reach out to a certified financial planner, a legal advisor, someone who can help you make those decisions, as well as let you know of any long-term impacts for those decisions. My name is Elaine Rubin, Senior Contributor and Communications Specialist here at Edvisor. Make sure to subscribe to our channel because you don't want to miss out on the information we help break down.